listening to the Non-Del Influencers Podcast, brought to you by First Funding. Join host Matt Coles as he delivers powerful conversations to help non-delegated lenders succeed and scale in today's market.
Welcome back to the latest episode of Non-Del Influencers Podcast. Very excited today to have one of my favorite colleagues in the industry, Jordan Higgins, VP of Non-Delegated at AmeriHome, joining us today. Thanks for taking the time, Jordan.
Matt, thanks so much for having me on today. I'm very excited to have this conversation.
Where in the world are you today?
Today, I'm lucky enough to be in my home office. I live right outside of Tampa, Florida. We moved here mid-pandemic and never thought I'd say this, but I love living in Florida.
Where did you move from?
We moved from the Dallas area.
Oh, okay. Nice.
Yeah.
Wow,
So I'm enjoying the beach and the fresh air and a little less concrete jungle over here.
You and a million other people moved to Florida during the pandemic.
This is true.
So how long have you been at AmeriHome now?
It's been almost 2 years since I joined the AmeriHome non-delegated team.
Got it. And what made you choose, or what's the career path that led you to the non-delegated side?
This is a great question and a story I enjoy telling. Like most of us, I accidentally ended up in the mortgage business. I had an internship in college that was working for an LOS company, and it was 2008, and we all know what happened then. So I just continued on with my internship and made my way through several different kind of facets of the mortgage business, learned lots of great partnership things with my time at Lenders One, had a really great opportunity with the non-QM space when that was getting going, kind of in the new iteration of non-agency. And then I went through a series of very tumultuous kind of mortgage jobs. We've all had this, kind of point in our careers, I think, and with the pandemic, and I decided to take a break. I stepped back from the mortgage business. I started my own yoga and corporate wellness business, and I was just chilling out on my yoga mat until AmeriHome called one day and said, "Hey, you know anybody in the Southeast?" And, AmeriHome doesn't make those calls often, so I was really grateful to have the opportunity to interview and end up on the team. And my grand entry back into the mortgage space couldn't have been with a better company.
Well, first of all, I need to hit you up about some goat yoga because I think I'm participating in a goat yoga class in the next couple of weeks. I've never done yoga, but if you put a little goat next to me, I'm sure I'll have a good time.
Of course.
I love talking to the AmeriHome colleagues because the barrier of entry for non-delegated, typically, First Funding over here, right, is a lot of broker to bankers. But you guys don't play in that broker space. So I would imagine that you're probably seeing more seasoned non-del accounts, right? They've been a non-del for 2 to 3 years before they really kind of come on your radar, because you're not going to be always necessarily working with the small emerging banker, although you guys do. But most of your customers probably would be in the more experienced season. What are the common themes that you see with those? Hey, we started off as a banker 2 years ago. Now we're ready to take the next step, and they come to AmeriHome. What's the common themes that you hear and that you see?
That's a great place for us to start together. And you're right, AmeriHome comes at the non-delegated space from the delegated direction, right? And I think that brings a lot of really specialized pricing and programs and expertise to our clients. You're right, we do have an emerging banker program, and we certainly work with those that are transitioning from the broker to non-delegated space as well. But what I find after 2 or 3 years in non-delegated, really the difference is that most lenders, most owners, right, stop thinking like an individual contributing loan officer and really start like thinking as an owner of a long-term business model. They shift away from that transactional business model to thinking about intentional scaling, how to tighten up their operations, how to have better partnerships, and really how to minimize any of those kind of fire drills for both their teams, especially their borrowers, and most especially their realtor referral sources. I think
That's
they also, I'm sorry, go
no,
ahead.
no, I was gonna say that's a really interesting, that's a great perspective because a lot of times that broker to banker conversion is the individual shop owner who's been the hunter of going out and
Yes.
originating forever, and then their 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 mentality is I want to grow my business. But some
Yes.
of them can't get out of that originator standpoint. But what you're saying is that once you
Next
get that
deal,
creative level,
next deal,
amazing.
next
Yeah.
deal, next
Yeah.
deal. You got to step back from that and start being intentional about how you scale your business, right? For scale and longevity. Absolutely.
Where
Absolutely.
do you see them scaling first? Is it, hey, let me try to do docs in-house, or is it let me try to do what do you typically see from your side of it?
I would say that the first stop is being much more intentional about their investor partnerships.
Yeah.
They want to move away from kind of like gimmicky short-term pricing specials and find these long-term partnerships that will consistently be at the top of their rate stack. And also moving away from, again, from transactional to partnerships. What happens when we get in a sticky spot together, right?
Yeah.
Am I working with someone that is going to be my true partner? Mistakes happen in this business. And I think actually the best partnerships are defined by how everyone reacts when a mistake does occur, right? That's how you build long-term trust and partnership. So definitely number one, I think they are taking a strategic look at their investor partnerships, finding someone that's consistently at the top of their rate stacks, acts like a true partner, and then the third thing would be moving forward. How long can I stay in this partnership? What additional steps forward can my business take? And can this investor come along for that growth with me?
So I love the perspective that you have, which is you said it at the beginning, you look at it from the delegated to non-delegated. Like that's your kind of your lens.
Hmm.
Um, I'm certainly starting to see a little bit of a pickup in people saying, hey, I think I'm ready to go either back into delegated. Because the story that I've heard, or that I've seen for the last 2 years is that
Hmm.
a lot of people were credit risk adverse, and investors were making it so easy to do non-delegated. They'll do all the disclosures, they'll do everything for you. So they're like, I just like that non-delegated space, and that's where I want to be. Recently, like super recently, within the last 3 months,
Hmm.
we started to see people start to creep back in and be like, hey, I kind of want to, what does that delegated space look like? Or what is that like going back into delegated look like? What are you hearing out there? And how do you coach people through that?
This is a really great question. I think it's a particularly great AmeriHome question, right?
Yeah.
Because we have such a strong delegated channel as well. Overall, AmeriHome is the largest bank-owned investor in the country. And what I would say, there's a lot to consider and kind of unpack in that question.
Yeah.
But really, the move from non-del to delegated isn't just this next natural step that you should be taking. This is a very strategic and, quite frankly, a very personal business decision that needs to be very carefully considered. Real talk. I think a lot of this desire comes from maybe like ego or maybe expectations or maybe let's call it margin envy, but their operational readiness isn't generally fully considered, right? Moving back to delegated or moving to delegated means that you, as the seller, own the underwriting risk. You have to manage QC findings, your total net worth requirement goes up, and your buyback exposure goes up significantly, making that move. I
I,
would also say, I'm sorry, go ahead.
no, no, go ahead, please finish your
I was
thought.
going to say, I really think that many lenders underestimate the cost of staffing a delegated model
Oh,
today.
I couldn't agree with you more, which is, and my talk track is listen, I'll support anyone that wants to move anywhere in your business model.
Mhm, mhm.
Margin envy is a good way to put it because they hear, oh, I heard them, but they don't. Yeah,
Mhm. Yeah,
yes, there are some bigger margins. That also comes at a bigger price and a much more exposure,
yes.
like you just said. And so, our kind of natural talk track on this side of it is, well, why don't you take docs in first, right? Or why don't you see how that
Great first step.
why don't you work on
Yes.
that part of it? Or how about you hire a really great processor and compare their underwrite to your non-delegated underwrite and see how that works out for you.
Yes.
Try to walk before you run type of thing. But there is, and I do, our president Nate over here, we do talk about quite a bit. Is I think we will see people go back to delegated in droves if if the non-del fulfillment partners all of a sudden have an expansion of turn times, right? That's when you're really
Sure.
going to see it. So if XYZ investor was 24 hours today and that's their favorite investor, and then all of a sudden they're 5 days in underwrite, right?
Sure.
The non-del is going to be like, I need to move faster. I'm going to bring this in-house, typically, right?
hmm
So
hmm
we'll see that quite a bit. And how do you get around, it's not the ego about it, but how do you talk them through what it looks
Sure.
like to give them a full picture? Take me through what that talk track looks like for you.
I think before we even get to the math, okay, we need to have a serious staffing conversation. To your point, to move into that delegated space, you really need to consider centralized processing. You probably need to consider a lock desk professional as well.
Yeah.
You also really need to have a really sharp post-closing department, and you know this more than anyone, right? To manage kind of the cost of funds as well as the capacity turn
Yep.
times. And we have to start having a more honest conversation around the lack of sufficient younger talent entering into this profession. I know we've talked about it for a long time, and I used to be the youngest person in the room. I'm grateful that's not the case anymore. We do have people coming in, but there's
Yeah.
really
Me too,
shrinking
Jordan. Me
talent.
too.
Yeah, right. Like at one point I was, but there's a shrinking talent pool for critical roles like processing and underwriting. Lock desk might be the most accessible, right? Still to today. So we have to start there.
Yeah.
You have to be able to be staffed appropriately. And then from there, I coach the lenders to do the math. You need to clearly understand the cost of your technology that you'll need to improve things like a true pricing engine, um, additional processing support, additional costs of QC and QC technology. Then you have to add in the cost of the underwriters. We know that's a very expensive resource in our business. You need to be prepared to set aside margins for that buyback risk that we already talked about. And then additional oversights from audit and QC findings as well. Those things don't come for free. We have got to figure out the expense side of the equation first,
Uh,
and then think
yeah.
about the pricing difference.
I'll also add that you need to bring your warehouse partner in on this journey because
Absolutely.
I have
Yes.
seen far too many times where a partner will come to us and say, "Hey, we want to do delegated." That is a much bigger ask with regards to
hmm
financial net worth and financial responsibilities,
Ability. Yep.
advance rates, everything that comes with it, and it is not an easy decision for a lot of people. And then oftentimes the next conversation they start talking about, because then they get into the delegated space and now they want to start doing hedging, which is another risk factor, right? So like
Yes.
you got
Yes. I'm
it.
so glad you brought that up.
Yeah.
Yes, because I also think that when I say do the math, it's hard to jump straight into that hedging mandatory sales
Yeah.
business model. Most need to start with a best effort model, right?
Yeah.
Due to either experience or their net worth. So they really need to understand. It's imperative to understand the spread between your non-delegated pricing and best effort pricing. Because even if if you have the talent and even if you have the net worth, it's hard to just jump straight into that model. You're going to need a layover in best effort pricing, probably, right? And lenders might be surprised to see that the difference might not always make sense, especially if you have a really strong investor partner in your non-delegated business today.
That's such a great question, and one that I think that we need to start implementing on our side, which is, okay, I know you heard about the margin. The margin envy is what I'm going to call it from now on. Thank you. Thank you
Yes,
to
love
you.
it.
Um, but are you margin envious of someone who's hedging, or are you margin envious of someone who's doing best efforts? Because there is a very big difference in that.
Yes,
And hedging becomes a much, much more expensive endeavor
absolutely.
with regards to technology and partners that you need to bring into your fold.
Sure. Yeah.
Love the
So,
love the growth. Encourage anyone that's in the non-Dell space to always look forward to growth and opportunity. But putting together a business plan about what it looks like, and I love that you're pen to paper, which kind of leads me to my next natural question, and I think we've hit on it
mhm.
already, which is when you come in as AmeriHome and you start looking at these lenders that are, or these non-Dell lenders that are like, hey, I'm ready to take the next step, I'm ready to grow. What are the biggest pitfalls that you see that go, okay, let's pump the brakes. This is what I'm observing in our early relationship. What are you typically seeing?
That's a great question to talk about specifically with who AmeriHome is in the non-delegated space.
Yeah,
I would say that volume growth doesn't break non-delegated shops. Get big. We want you to be successful. We want you to grow your sales team. We want you to grow your origination volume. It's not the volume growth. It's not paying attention to the operational details along the way that breaks the non-del shop down. This means a couple things. Maybe outgrowing some fulfillment partners that were great when you were smaller, but now you need something more sophisticated, or maybe it's time to pull some of those processes in-house. To your point, maybe Docs is a really great place to start.
yeah,
The next thing would be assuming that all investors interpret in agency guidelines in the exact same way. They do not. You need to pay attention to overlay matrices, and you really need to get to know your investor partners and what I would call their personalities or their appetites, right? Or maybe their risk tolerance is another way to say that. We don't slow down enough and ask enough questions of the investor partner to understand those nuances. And we just think everybody underwrites the agency guidelines the exact same way. I think that's two. And then the third thing would be that they don't spend enough time communicating with their investor partners on a regular basis. I specifically mean people like myself, the sales executive. Let me give you two quick examples of that.
yeah,
So recently, I had a great conversation with a client, and it wasn't just me, right? I bring in my operations account manager, I bring in an underwriting manager, and we have a constructive conversation about how our business can run more smoothly together. My team identified that a lot of their files weren't coming in with cover letters, and they didn't have clear income documentation in their files. And that extended turn times, that added touches to their file, that made it more difficult for my team to put the pieces together.
right.
So they heard that feedback, they took that feedback, they implemented that feedback, and now we've seen their touches come down. I would say their team's confidence, right, in the partnership has gone up. And those are some hard conversations to hear and have sometimes, but that's where like the really good stuff is in a
Yeah,
partnership.
absolutely.
Yeah. The second part of that would be that I had someone reach out literally just this week and said, an owner, and said, I want to know what my team's doing well, and I want to know what my team's not doing well. And I
Yeah,
said, give me a week. I'm going to work with my various departments. We're going to organize this together, and we're going to have a conversation together. Taking the time to communicate at that level with your sales executive is how you avoid the pitfalls, or have your partner help you shine the light on the pitfalls before you stumble over them.
I'm smiling because back in my account executive days, which wasn't too long ago, I did have a customer that wanted to move from non-Dell to Dell. And it's funny that
Mhm.
I had a very similar conversation, which is, do you know how much time my underwriters spend on the phone with your LOs?
Mhm.
I don't think the owner knew
Right.
how challenging some of the LOs on his staff were on the underwriting staff. And now you want to in-house that underwriting staff to you, and now that you would have an employee that you think that the underwriter is going to be patient with the LO. It's just one of those conversations where oh,
Sure.
everything runs so smooth because I'm a high volume shop. It's like, no, you got to know who your DNA is, right? The DNA of the originators that are going to be now in housing underwriting, and how, frankly, how rough they are sometimes with staff of your partners.
Yes.
Not a problem when you're dealing with it on the TPO side, but when you're in a delegated side, it becomes a much bigger issue for you as the business owner.
Let me give you a very tangible takeaway for your audience. If you are a non-delegated shop, you should be requesting your monthly scorecard every single month from all of your investor partners, and you should be looking at them. Okay. And in this day and age of AI, you should be running them through something and you should be looking for trends. That's how you grow. And that's how you grow strategically and avoid the pitfalls.
Yeah, no, that's a great point. I mean, that's one of the things that we look at as a warehouse line. We ask for
Of
scorecards
course.
for the investors. And I can tell you in credit committee meetings, when we see someone who averages 3 touches per file versus 8 touches per file, we kind of understand who the customer is at that point.
Great point. Yes, yes. Well, and this, something that even better than myself, of course, is not paying attention to their funding timelines. This is a place that I see non-DALs kind of stub their toe, right?
Yeah.
They're leaking margin and they're decreasing their capacity if they're not paying attention to what's going on post-close. They need to have somebody appointed to and paying attention to those things, right? That's how they really keep their margins tight and keep their capacity open for any bulges that come up, right?
I do. It's a fantastic talking point. Thank you for being so eloquent about it because I think it's fantastic. But one of the things I do like to talk about on this podcast, especially with people that are in your position, is what's the hidden gem of the non-Dell space that you love to talk about that, everyone knows about the flexibility of price and some of the
Mhm.
other, the control that comes with it. What's some of the what are some of the bullet points, the golden bullet points that you love to talk about when you are talking to non-Dells that maybe they don't think about first?
Absolutely. Now, we can't diminish the importance of pricing.
Yeah,
Okay.
of course.
If someone is strictly in the broker business, they are leaving money on the table with every single deal. But the secret hidden gem of non-delegated is insulation from risk. The credit risk, the underwriting is squarely with your investor. There's a very extensive rep and warrants around the work that your investor partner is doing. And it allows you to scale your business without unnecessary risk while feeling like you have control over your timelines. You have control over your partnerships. You have control over your borrower experience and your realtor referral business experience. And then beyond that, you kind of are in this really nice sweet spot where you can have product confidence, right? So when new products come to market, you can learn to stay competitive with these broad product menus, but you don't have to build all that internal expertise on your own. We routinely host non-agency training products one-on-one for our clients. We routinely have underwriting calls where we talk about common issues and themes that we're seeing in files. We get to give you that education to our clients. You don't have to figure that out all on your own, which helps you avoid risk as well. And then also to go back to the staffing, this is a really nice way for more of your junior team members to become more educated about the mortgage space, products, pitfalls, etc.
Right.
And so those junior members can make less mistakes along the way too. That education can be with the right partner. It doesn't have to be squarely on the lender's shoulders. So I think really it's the hidden gem beyond just the pricing, which is very important, is that non-delegated lets lenders grow without that unnecessary risk.
Yeah, absolutely. I just, there's so many cool aspects of it, which, especially right now, I'm a big fan of the branding opportunity. I know, and I've really started to ask loan officers this question is, have you ever had anyone question who is the lender that's named on the loan docs when you're brokering out? Like, I
Ugh,
know that
yes.
happens. I know that
Hmm.
happens, right? And so you've
Mm-hmm.
done all this work to build out an amazing brand as an LO, and then all of a sudden there's a name change at the closing table. I have to believe that some borrowers question that and lose a little bit of faith. I thought I was doing a loan with XYZ Mortgage. Who's this? You know?
Right. Sure.
So
Yeah,
just that branding opportunity alone is fantastic for me. But
absolutely.
what is the AmeriHome advantage for non-Del? Like I know that you guys have such an amazing reputation. I hear from our lenders that you guys are such a great partner. What do you go out and highlight as the advantage that you guys work with?
Absolutely. Thank you for asking. AmeriHome is not just a non-delegated investor. I genuinely believe that we view ourselves as a true long-term operational partner for our clients' business. Taking on the underwriting and the credit risk for our clients, doing that in an efficient way, both from a time and a cost perspective. We work very hard to publish very clear overlays so there's not any guessing or gray areas or moving targets. We do offer support for disclosures as well. So if that feels a little scary for someone, we have solutions and partnerships for that.
Yeah.
It's also important to keep in mind that AmeriHome Correspondent is backed by Western Alliance Bank. So we are in a very choppy, volatile market. We also saw some credit markets freeze up, right, during the pandemic. When
Yeah.
you have the strength of a bank like Western Alliance behind you, it really helps provide stability through these volatile market changes. And also, we love the experience of taking someone from that emerging banker program all the way through a fully sophisticated, non-delegated program. And if they're ready to take that next step to delegated, we have one of the strongest and best performing delegated teams in the country.
Yeah. I mean, First Funding has seen some of our lenders start off with a $2 million line. This just happened. It's pretty crazy. They started off with a $2 million non-delegated facility, and I think we just got them approved for a $125 million hedged account. It's incredible to see. It's so fun to watch, to see
Oh,
the
yes.
mentality of it. And everyone that's watching this podcast, that was an 8-year run. Didn't happen in a year, right?
Yes, thank you. Right? Oh, Matt, I love that you said that. If I had to distill the absolute best part of my job, it is watching somebody take all of these steps and graduate beyond myself, right? Or
Yeah,
my roles and responsibilities. And
yeah,
it's really heartwarming and encouraging, especially for the independents that have put all of this on the line, right?
for sure. For
It's
sure.
really great to watch that growth.
All right. So what's out in the marketplace that has you really, really excited? What's going on in your world today that you're bringing to your lenders that you're telling your lenders that they got to be focused on this? What's got your attention right now?
Such a great question. I love the JFK quote about the time to repair the roof is when the sun is shining. Now, stick with me through this analogy, right? But I genuinely believe that the lenders who are winning right now are the ones that are expanding strategically. We're in a little bit of a slow market at the moment, right? And the ones that are preparing for when it's raining refis, let's call it, right, are doing the work and putting the work in now. There is a broker to non-delegated revolution going on with like exclusivity decrees, more conversations that are happening like this, the slower market that we're experiencing. Large broker shops are quietly preparing to move into this non-delegated business model. So when production really ramps up, they're in a strategic position to earn more on every loan, keep that borrower for life, and reduce any friction, right, to get to the closing table. So I think that that's going on. I also have seen kind of a renaissance of individuals who come from the very large retail shops. They ran a very successful branch and they are ready to strike out on their own for the first time, which is really exciting to
Yeah.
watch. Those individuals I find are blowing right past the broker model and starting at non-delegated. Because for the last 5, 10, 15 years, they've seen the benefits of living in a delegated company. So they want to start right away, right, with that same business model and all of those advantages and businesses, advantages and that business model and control. The other thing that I've really noticed happening that is making me excited is that lenders are spending time to diversify their product offerings. They are really starting to perfect and understand the way that non-agency products are working and the right borrowers for those solutions. So that way they can say yes to more loans, right? They're feeling they're building their skill set, they're building their confidence, they're building their partnerships for their entire non-agency suite of products. And then lastly, I would say that when we have some of this younger generation coming in and maybe stepping into some of the beginning of the primes of their career, the younger generation's really leaning more into AI solutions that are reducing cost for companies, increasing productivity, and using some really smart, cool tools to work on borrower retention as well. So I think the thing I'm most excited about is that I feel like non-delegated is just having this quiet revolution from all evolution and revolution from all these different directions. And this is not a random change. This is a strategic reset, right, for people.
I could not agree with you more on a couple different things. The non-del space is exploding. I mean, I live it every day, right? The amount of inquiries that we get about a warehouse line and the retail branches that are coming in and just like you said, skipping the whole broker space. I'm going to wholesale it out for a while. Let me figure this out. It's not happening, and that is a younger demographic, and they are leveraging AI, and they are. Common theme in this podcast is scalability, which is if rates drop 1% tomorrow, I know from the last cycle in 2020, 2021, people were not prepared. And we busted at the seams, and realtor relationships went to hell in a handbasket a lot of times because we're just super focused on refinances. And I think that the best non-del lenders today have a very good repeatable manufacturing process that they know that they can volume through.
Absolutely. And I feel like the smartest non-dels out there are scaling with intention, building with intention right now while they have the bandwidth to do it, right? And they're focused on how to own the borrower, protect their margin, and scale without inheriting unnecessary risk. And that's what the non-del channel does.
Awesome. Jordan, I can't thank you enough. Amazing time with you. Super insightful. How do people get a hold of you?
You can go to our AmeriHome website, and you can also feel free to email me, jordan.higgins@amerihome.com. We'll keep it simple.
Awesome. I appreciate you taking the time out of your day, and we look forward to seeing everyone on the next Non-Del Influencer podcast.
Thank you.
Thanks for tuning in to the Non-Del Influencers podcast, powered by First Funding. For more resources and episodes, visit nondelinfluencers.com.